Wondering how much home you can afford? Whether you're a first-time home buyer or looking to upgrade, this episode is packed with essential insights on debt-to-income ratios to help you make informed financial decisions. So stay tuned, hit the subscribe button as we unravel the mysteries behind these numbers and provide you with the tools to navigate your home buying journey confidently. This is Joe Harris. I'm here with Lindsay Clark. How you doing, Lindsay?
I'm doing great. Thanks for having me.
So we're talking about the fun stuff of debt-to-income ratio, also known as DTI, or basically the affordability.
That does sound like fun stuff.
It does. Well, it's pretty necessary.
Yes.
Like it is one of the biggest factors in qualifying for a house. Mm-hmm. So pretty important.
Yeah. I mean, basically, when I think of debt to income, the biggest question that comes to my mind is, what does it mean and why is it so important? Can you think of,
what does
how
it
to
mean?
explain that to clients?
Right.
Yeah.
So debt to income, it's just that. It's your debt to your income. So how much debt do you have? And the debt that they look at are monthly reoccurring expenses like a minimum payment on a credit card.
Okay.
Student loan payment, right?
Mm-hmm.
How much is your student loan payment? How much is your car payment? Do you have other mortgages you pay? Or these are steady and reoccurring things that might show up on a credit report, and some things that don't show up on a credit report, like if you're obligated to pay alimony, child support, or separate maintenance, for the states that have separations and things like that. So there's a bunch of things that go into that debt to income. So you take a look at your total debt picture, all the outstanding monthly debt obligations, and you divide that by your gross monthly income. The gross monthly income is not necessarily your take-home pay either. It is, if you make $120,000 a year, mm-hmm. your gross monthly income is $10,000 a month. And if you had $2,000 a monthly debt expenses like credit card payments, minimum credit card payments,
sure,
student loans, car loans, you take that $2,000, divide that by the $10,000, well, that's a 20% debt to income ratio.
Okay.
Now you add a housing payment on top of that. Maybe the housing payment's $3,000 or $2,500. Well, now you're at a 45%. So it's $4,500 divided by 10,000 is 45% debt to income ratio.
Seems like a pretty simple equation, just a lot of things that are factored into it.
A lot of things are factored in, and it seems very simple, but this is why underwriters are needed because,
mm-hmm.
If you're self-employed, it's a little
mm-hmm. harder
to figure out what that gross monthly income looks like. If you have certain deductions that have to be added back in, it can get complicated.
Okay.
But as a rule of thumb, that debt to income, typically it has to be below 45% mm-hmm. Of your gross monthly income, your debt, and including the new housing payment. And, some loans will let you go higher to 50%, 55%. Sometimes on VA loans, they'll let you go higher than that. But then it's a question of, should I go higher than that?
Right. I think at some point, ethics need to step in and say, okay, am I putting the buyer in a good situation financially?
Right. From a loan officer perspective.
Right.
But there's sometimes what we call compensating factors, and we're not going to get into those right now.
Okay.
But the loan has to make sense.
Sure.
Loan has to make sense. On a conventional loan, which is a normal Fannie Mae or Freddie Mac loan, mm-hmm. typically 45% is the max. You can go up to 50% with lots of compensating factors. And FHA, they'll let you go to 55%. VA doesn't have a max, but they have a lot of other guidelines around that.
Good to know. So how does a lower debt to income ratio influence your mortgage approval process? And are there specific DTI thresholds that lenders prefer? You had mentioned 40% or...
So the lower debt to income just means a stronger loan,
okay.
right? And so let's say your debt to income is 45%. Mm-hmm. You might not get an approval at 46% if it's a conventional conforming loan. Mm-hmm. Most loans these days have to be run through what's called an automated underwriting system, which is a fancy word for a computer, right? that looks at all the factors on the loan and says that this loan makes sense. And it looks at your debt to income, credit score, how much you're putting down, how much the house is, and things like that. It does look at these factors for approvals. But once you go over, on a conventional loan, 38, 30, 36, 38, 40, those approvals are going to be harder and harder to come by the higher your debt to income is. And if you're over 50, you can forget about it on most conforming conventional loans. Again, the Fannie and Freddie loans that are out there.
Okay.
VA doesn't have as strict of a guideline on debt to income. They will allow a little higher debt to income. Mm-hmm. They look at the whole picture. They look at how much money is left over after you paid your bills, and they have some calculations for that. Mm-hmm. FHA will let you go to 55% debt to income. Now, that's the FHA rule. Certain lenders might say, no, we cap you at 50% or 52%.
Right.
So those are called overlays. They overlay on top of the actual guideline.
Understood. So let's say, for instance, you are one of those buyers that maybe your debt to income is a little bit higher than what you would like. So what are some practical steps that you can take or that you can give tips to help us before applying for a mortgage on how to make sure that we stay within that threshold or that we can lower our debt to income?
Okay, great question. How do you lower your debt to income?
Yeah.
Right? So there's really two ways. You lower your debt or you raise your income. Right? No joke.
Makes sense.
You lower your debt or you raise your income.
Okay.
Now, there's other things you can do. Like if you have assets, if you have money in the bank, you can pay off a credit card. You can pay off a student loan. You can pay off a car loan. These things can be done at closing. They can be done before closing. But, my best advice I can give someone out there that if they're questioning their debt to income, how do I calculate it? What's involved? Where should I be? You need to talk to a professional that cares about finding you. A lot of loan officers will say, oh, you don't qualify and send you on your way, which I don't think is the very professional thing to do.
Yeah.
The professional thing to do would say, listen, looking at your situation, you could qualify if you do one of these. These are a couple ways that you could qualify. One way might be paying down debt. One might be putting more down on the loan. Might be, there's lots of different ways to get from A to B. So the best advice I can give anyone out there that's looking to either know what their debt to income is or how it applies to them is to talk to a professional mortgage loan originator. We have lots of them here, so give us a ring. The information's down below.
Shameless plug.
Shameless plug. But in reality is I know what our loan officers do. They help people.
Right.
And I can't say that for all loan officers out there, but there are a lot of good loan officers out there. I mean, we only do loans in Florida. So I know there's other loan officers in California, Nevada that act like we do, but there's a lot that don't. So make sure you get a good referral for a good professional loan officer that knows how to look at a whole file and help people get approved, not just tell them they don't qualify.
Right. So beyond getting approved for a mortgage, why is maintaining a healthy debt to income ratio important for long-term financial stability?
Well, if you look at it this way, you've heard the term cash poor, house rich.
Yes,
I don't know
have.
if I got that right. But if you buy too much, spend too much on your house payment, then you're going to take away from money that you have to do other things.
Very house poor at that point.
House poor, right? Or house, I don't know how that saying goes. I probably botched it. But so the point is that, you want to keep your debt down always. Sometimes debt's smart. I think, depending on the situation, credit card debt isn't necessarily bad. A mortgage is debt, but it's debt that helps you build equity.
So like good debt versus bad debt.
Good debt, you can look at it that way.
Okay.
But the more you can pay down or pay off, the better off you're going to be.
Understood. So what other factors should buyers consider to ensure that they're making sound financial decisions long term?
Well, first thing you want to do is talk to that loan originator and see what needs to be done. Am I on the right track? Am I paying the right things off? Because sometimes some payments, there might be a credit card, you only have to pay down $2,000, but it's a $500 a month payment. So it's like that has more value paying that $2,000 off than $2,000 over here. That's a very low interest rate. Their payment's only $100 a month. It's like, no, go for your biggest bang for your buck. But that's going to take a professional knowing what they're looking at. So I don't know if I answered your question on that.
You did.
Okay.
You did. Well, how can home buyers ensure that they stay within a comfortable DTI range after purchasing a home?
Then don't run out and get a bunch of new debt. So,
all the new furniture, all the...
I've heard loan officers in the past that don't work here anymore. I'm kidding. I've heard loan officers say things like, well, don't buy that till after you close on your home.
Right.
Well, they're just telling them, hey, listen, put yourself in a bad situation after I get paid. Right.
Oh, that's terrible. And that feels icky.
It does. And I hear it said all the time, and sometimes it makes sense. But the reality is that, if you're that tight, you really should think about not bringing that purchase in after the fact.
Sure.
And to protect your credit and protect your debt to income even after the purchase.
Awesome.
Because that'll put you more stable for a longer period of time.
Got it. Well, those are all the questions that I had.
Okay, good. Well, look, if you're out there, if you're looking to qualify for a property, you want to know what your debt to income is. You want to know if you qualify or not. Those are things we can help with. So, reach out down below. There's probably a form or a link down below. We'd love to talk to you. Even if you're not in our area, we'd love to give you sound advice. That's all I got. Thanks for watching. We'll see you next time.